Welcome back, and what a week it has been for the metal prices in the Indian markets. The metal nifty or even the metal stocks in the Indian markets and globally have rallied really high. We saw many of them actually hit a 52-week highs as well. Whether or not this rally will sustain or does it has more legs? To discuss that further, we have with us Simona Gambarini. She's commodities economist at Capital Economics Limited. Simona, hi, good to have you. And what a week it has been, starting with steel to iron ore to copper to nickel prices. Almost everything has been trading at a multi-week, multi-year highs. What is your sense? Where do you see so much of strength coming from?
Well, there have been a few issues this week that have prompted metal prices higher. One of those has been a weakness in the dollar following the FOMC meeting on Wednesday. And then in the cases of some metals like copper, there have been rumors that China might ban imports of scrap copper starting from the end of 2018, and that has propelled prices higher.
Simona, starting with the steel and the iron ore prices, first of all, I mean, as you mentioned, the China has been cracking down on low-grade steel, excess supplies. The inspection teams have been sent out as well. Would you say that that has now been factored into prices? Since there is enough and more supply of steel and iron ore, we perhaps could see some declines come in from here?
Yes, we do expect some declines coming from here, particularly for iron ore. We expect some clamp down in supply, but supply is still growing quite strongly. At the same time, demand should actually lose a bit of momentum in the second half of the year, and this is because China is actually withdrawing stimulus in the market, particularly in the property market, which is heavily reliant on steel and iron ore. So lower demand in the second half of the year should somehow weigh on prices, because obviously, as you said as well, supply remains abundant despite the clamp down.
Simona, coming on the base metal prices also, the kind of run-up that we have seen in copper has been due to various things. There have been mine supply concerns. We also have seen aluminum inventories go down. The data, the economic numbers from major consumer countries has been positive as well. At a two-year highs on copper, comfortably sitting above $6,000 per ton, how would you want to trade it?
We would go short. We think prices will fall back. There has been a lot of buoyancy in the market, but it doesn't seem justified. It's true we had supply disruptions in the first half of the year and some potential disruptions in the coming weeks in Chile, but inventories, total inventories on LME, COMEX and SHFE combined, they're up 40% year to date. So there seemed to be enough supply of metal to actually meet demand. So there has been a lot of speculation in the market, and we do think that has played a major role in boosting prices. And the latest speculation has been on the back of potential imports ban in China. But even that should not actually weigh on supply excessively going forward. It's all been a little bit exaggerated, and it's more been an opportunity for investors to actually boost prices even higher, but there has not been a real fundamental reason for such a rally in prices.
How about the other metals then? Would you say the same about the other metals like zinc or a nickel or an aluminum for that matter? Because the individual fundamentals for some of them have been supportive, but would you say it has been exaggerated for them too?
We do expect industrial metals in general to head lower in the second half of the year. For zinc, there have been supply disruptions over the past couple of years, supply cutbacks actually that have been tightened. First, the supply of zinc ore, and now we are starting to see some tightness at refined level. But at the same time, Glencore yesterday released its half-year report, production report, and zinc production was up strongly because higher prices are already incentivizing miners to reopen idle operations. So that should actually ease some of the tightness in the market in the second half of the year. With regards to nickel, we think it will basically trade at current prices for the remaining of the year, but much will depend on what happens in the Philippines, whether they will ban exports or not. And the situation is quite uncertain still at the moment. So prices are likely to be quite volatile around any news that that production might be disrupted. But in general, metals should edge lower in the second half of the year on China concern, because we do expect actually growth in China to slow in the second half of the year. So that should be enough to prompt prices lower.
All right, Simone, I will let you go at that. Thank you so much for joining us, for making sense on the kind of rally that we have seen in metals. And that's the view from Capital Economics, that we might see some correction at these higher levels because the production, of course, has gone up because of those prices. But there's another thing that has been shining bright, and that's the demand for diamonds, which has seen a bit of an increase in some countries. Of course, if you look at the year-on-year basis, the Jan to June sales have seen a decline of 4%, is the view coming in from De Beers. The Indian market demand, though, has seen some rebound since demonetization, but now the Indian markets are staring at GST, and that impact has led the industry reeling under. Markets are anticipating that it would perhaps take another 4 to 6 weeks for the demand of diamonds to come back and the industry to go back to the normal. We also have seen the prices on diamond actually continue to be on the higher side. It has seen consolidation in the previous year, but this year, yet again, there has been some support. Joining us now is Bruce Cleaver from De Beers to talk more about that. Bruce, hi. Welcome on the show. My first question to you is about the view on the demand production, or rather diamond production, as we go forward. What kind of a number are you looking on that?
So our production for the first half of the year of just over 16 million carats is about 21% up on the same period for last year, where we did about 13 million carats. And that reflects a continued improvement in the rough diamond market over some of the difficulties that we faced sort of towards the end of 2015 going into 2016. So all of our operations across our 4 big countries, Botswana, South Africa, Namibia and Canada, have performed very, very well through the first half in terms of production.
While, Bruce, we understand India continues to be a strong market for you, but where has been the major demand growth that you've seen coming from?
So all rough diamonds that we mine and sell, of course, turn into polished diamonds, and they turn into set diamond jewelry and are sold to consumers in the main diamond markets across the world. The 3 main markets in terms of demand are the United States, it's about 50% of global demand, China, which is about 16%, and India, which is about 8%. We've seen a moderate recovery in all of those markets in the first half of 2017, perhaps India performing the best of all of those. So the US, we think over the first half, it's quite early to tell given that all the numbers aren't in, but we think that the US is moderately up across the year. Some of the chains had more difficult time than some of the independents, but continued good growth in the US. China has shown some growth in local currency, and so that's perhaps returning to a more normal market after some difficulties in 2016. And India's done, we think, very well, particularly the larger chains in India. We think India's recovered from demonetization perhaps quicker than we thought. So we've actually been very pleased with the Indian market performance.
Since you mentioned India, Bruce, we're just about recovering from demonetization. So you might have seen some recovery in the last couple of months. But now with GST standing there, the industry has seen some impact of that. What is your sense?
Yes, I think, as I said, 2017, the first half has been a better year than the comparable period of 2016. Introduction, as you say, of a GST both on rough and polished diamonds, on rough diamonds of 0.25%, on polished diamonds of about 3%. But I think important to say on the polished diamonds side that that was not off a zero base. That was replacing various other state taxes with a more unified tax regime. So whilst obviously the industry wasn't overly pleased with that, we don't think that that is of such a scale that should have a material impact on the market. I would agree with you that India is probably not yet in the place it was maybe 2-3 years ago, but a pleasing recovery in H1 2017 over H1 2016.
All right, Bruce, we'll let you go at that. Thank you so much for joining us. That's a view coming in from De Beers that demonetization wasn't such a great period. GST, the scale of it is not so big, but since the industry was not ready for it, is the reason that it would take some time to come back in sense of a strong demand. But with that, it's completely out of time on this edition of Commodity Champions. Thank you for watching.